Hello friend, welcome to all of you. This online lecture of SYBCom subject Business Economics Macro Sem-IV, and we are looking here chapter number 1 Money and 1.3 Supply of Money and Credit Control Methods used by the RBI. And some previous lecture we also discussed about some point of this topic number 1 money. We discussed the meaning and functions of money, and we also discussed some demand for money 1.2. There are two approaches: the classical approach explained by the classical economics and the Keynesian approach, demand for money. And the next point is about the supply of money. The supply of money, there are some points like the credit creation of commercial bank throughout the primary and secondary deposits. The commercial bank create the multiple way of money and they play important role in the money supply. Also we looking into some money measures of RBI like M1, M2, M3 and M4, narrow money and the broad money concept like M1 and M3. In today's lecture we discuss the credit control methods which is adopted by the central bank of every country. And in our country RBI use the credit control methods. Two methods, the quantitative methods and qualitative methods. So let us begin with the money supply. What is the money supply? Money supply is the total stock of money circulation among the public at a particular point of time in an economy. So at a particular time in economy, how much total stock of money in hand of the people and in economy, it's called the money supply. So it is generally presumed that there is a supply determined and policy of the money supply determined by the government and central bank of the country. Besides the central bank, the commercial bank is also play important role into the money supply of every country. An excessive money supply create inflation and instability in economy, and therefore the purchasing power of people cut down during the period of inflation. So therefore need to control of these excessive money supply, the central bank use the credit control methods, quantitative and quantitative tools. So every central bank of country is responsible for controlling the volume and direction of credit in the economy. So they use the various methods. There are two methods used into the India by RBI or central bank of country: quantitative and qualitative methods. So let us begin with these two methods, quantitative methods and qualitative methods. So credit control method adopted by the Reserve Bank of India, and there are the two methods. As per this chart, we are looking here the two methods, the quantitative methods and qualitative methods. And there are some 2 points also. The bank create variable cash reserve ratio, means cash reserve ratio, statutory liquidity ratio, repo, reverse repo, open market operation. In quantitative methods, the fixation of margin, requirement, rationing of credit, moral suasion, publicity and direct action. So what is quantitative method? The aim of the controlling of cost and quantity adopting by the central bank techniques is the quantitative methods. So therefore they use the bank rate, market operations and variation in reserve ratio. The purpose of this quantitative method is reduce quantity or volume of money in the economy or increase the volume or quantity of money in economy. And on the other hand, the another method is the qualitative method, and the qualitative method of control use the direction of the credit. This involves selective credit control and the direction. So this qualitative method is used for the given direction of money supply in the economy, which purpose money used and which purpose are not used. So first we looking at some quantitative tools for the credit control. So RBI use the quantitative methods to the control of money supply. This instrument lead to the increase and decrease in cash from the commercial bank, because commercial bank create multiple way of money, their credit creation function, and therefore the excessive money supply in economy. Therefore the amount of of total credit increase and decrease, the RBI use the quantitative methods. This help to reduce or increase the volume of total money supply. So first tool into this quantitative method is the bank rate. So RBI Act 1934, the section 39, the bank rate or the discount rate is the rate fixed by the central bank at which rediscounting the first class bill of exchange of government security held by the commercial bank. So rediscounting rate on the bill by the central bank to the commercial bank is called the bank rate. And very short period the RBI given loan to these commercial bank, and this loan they are charging the rate, it's called the bank rate. So bank rate is the interest rate charged by the central bank at which provide the rediscounting to the bank through the discount window method. The central bank controls the credit by making of variation into the bank rate. If the need of economy expand the credit, central bank lower the bank rate. When the bank rate is low, that time the rate of interest is also low for the customer, and there is a more demand for the loan. Excess money supply is created into the deflation situation and recession situation. But during the inflation high tax level, the central bank increase the bank rate. So increase the bank rate means the increase the rate of interest, and therefore the reduce into the demand for the loan, higher rate of interest. Because rate of interest and demand for money, there is the opposite relation in point of view of the investors. So when the higher rate of interest, there is the less demand for money for investment. So opposite happen in the credit contract in the economy. So lowering the bank rate is offset into the deflation situation tendency, and rising the bank rate is controlled to the inflation situation. The present bank rate in this situation is the 4.25% used by the RBI. The next is the variable cash reserve ratio. Under this, RBI controls the credit worthiness of the bank, including the cash reserve ratio means CRR, and the statutory liquidity ratio tools means the SLR. So variation cash reserve ratio means there is a two ratio, cash reserve ratio and the statutory liquidity ratio. So let us begin with the first, cash reserve ratio. So every commercial bank required by RBI Act 1934 section 42 maintain a minimum percentage of deposit into the central bank in proportion with their cash in respect with their demand and time deposits. So minimum amount of reserve with the central bank may be either percentage of time and demand deposits separately or total deposits. So some percentage keep the outside into the RBI account every commercial and the other banks. Therefore their liquidity and cash distributing ability is reduced from the increasing CRR. Whatever amount of money remain with the commercial bank over and above the minimum reserve known as the excessive reserve. It based on the excessive reserve that commercial bank can create the credit. So the larger size of excessive reserve, the greater is the power of the bank credit and multiple way of money created by this all commercial bank. So reducing this excessive reserve, during the inflation, central bank increase the CRR. So increase the CRR means reduce their cash amount to distributing of loan, and reduce the amount means the loan is distributing a lower, and lower loan distribute means the lower multiple credit creation. It can also be said that the larger required of reserve ratio, the lower power of the bank create the credit, and vice versa. When the central bank rise the CRR, commercial bank, it means latter as required keep more money within the RBI account, and the excessive reserve with the commercial bank are reduced, and they can lend less loan and the less credit creation, and during the deflation the vice versa situation. At the present, the CRR, cash reserve ratio level, is the 3%. Next is the statutory liquidity ratio. It's called the SLR. Total deposits by each commercial bank have kept in cash, gold and government security. This is called the statutory liquidity ratio, SLR. So the binding of SLR on all commercial bank as per the section of 24, the Bank Regulation Act 1949, banks cannot use the SLR deposit for the lending for their customer loan. So keep the certain percent of some liquid asset as per the Bank Regulation Act section 24. Bank achieve the SLR by investing into the government security equal to the SLR. So when they increase the SLR, reducing their liquid asset, and basis of this asset they can borrow the loan from the market. So reduce these asset means they reduce the loan taking ability of the commercial bank from market and distributing loan capacity for their customer. If the RBI rise the SLR, the credit worthiness of the bank will be reduced and credit crunch will be occur. So, and if the RBI lower the SLR, reduce the SLR during the recession, the credit worthiness of bank increase and credit expansion is increased. So, in this pandemic situation, COVID-19, RBI reduced the SLR and it is constant to 18%. The next is repo and reverse repo, means repurchasing option and reverse repurchasing option. RBI started the repo and reverse repo transaction since 1991 to 91 and 92. The repo and reverse repo are the most important instrument RBI monetary policy use as an instrument daily use. The repo rate is the repurchase obligation a repo transaction can made on any item. So in the transaction, if the item of sold today, the item is repurchased at a predetermined rate after the certain period. This repurchase date is called the repo rate. So very short period of the time when the bank is purchased the RBI's security, that time they reduce their cash or reduce their credit worthiness, and after some time RBI repurchase the securities, that time their credit worthiness is also increased. So the repo rate is used for the short term control of money market, very short period of time when the commercial bank give loan to the RBI, that time they reduce their credit worthiness, and when the RBI repurchase their securities, that time increase their credit worthiness. Generally the gap between the repo and reverse repo is 1%. So the repo rate is used short term control of money market. Based on that, the short term interest rate is regulated by the RBI. So it is a short term interest rate regulated by RBI. In COVID-19, RBI decreased the repo rate and at present it is the only 4%. And on the other hand, reverse repo. In reverse repo transaction, commercial bank lend to the RBI by purchasing government bonds from the Reserve Bank. These loans are for one day. The process by which the Reserve Bank repurchase a bond on the second day, repay the loan to the commercial bank, it's called the reverse repo transaction. So repurchasing of the all bonds on the second day and selling into the first day. So it is the reverse repo rate. The reverse repo transaction reduce the short term holding of bank, but the RBI change the reverse repo rate, increase or decrease holding of banks required. So RBI rise the reverse repo rate in the time of inflation. The key object is for the bank lend more to the Reserve Bank and consequently reduce the liquidity of banks. So bank lend less to their customer when the RBI increase these reverse repo. Conversely, when the currency depreciates, the RBI lower the reverse repo rate. The bank should be lend less to the RBI and increase the liquidity of banks. As a result, the bank lend more there for customer in inflation. In the COVID-19 pandemic situation, RBI reduced their reverse repo and its present is 3.35%. The next and the last one is, and but not least, the open market operation tool used by the RBI for the quantitative credit control. The open market operation and another method is quantitative credit control used by the central bank. This method is referred to the sales and purchase the security bill, bonds and government as well as the private financial institution of central bank. So, but in narrow sense, it is the simply means dealing only in the government security and bonds. So, into the situation of inflation, RBI selling their securities and bond to the commercial bank and the institution, financial institution and people. The people purchase this and reduce their purchasing power. And during the deflation, RBI repurchase their securities and bond and increase their repurchasing power. There are two principal motives of open market operation. One, to influence the reserve of commercial bank to control their power of credit creation, and another is affect the market rate of interest so as control the commercial bank credit. The success of open market operation depend upon the constantly velocity of circulation of bank money. But the velocity of credit money is not a constant. It is increased during the period of big and the boom period business activity and decrease in the period of falling prices. Also, this pandemic period, there is a decrease in the velocity of money. Where the policy contracting credit by sales security by the central bank and may not be successfully by increase the velocity of circulation of bank credit. So these are the some quantitative tools which is purpose of the reduce the quantity of money supply or increase the quantity of money supply. Next is the qualitative tools, which is the purpose is the given direction to money supply and what purpose money should use and what purpose money should not be used. So in that, first is the margin. So qualitative method credit control are means regulate the control of supply credit among the possible users. They are different from the quantitative or general method aim of controlling. So here is given direction to money supply. So first is fixation of margin requirements. So gap between the mortgage value and the loan amount is called the margin. So this method is employed to prevent excessive use of credit to purchase or carry security of speculators. The central bank fixes the minimum margin requirement and loan for the purchasing or carrying security. Suppose we given the 1 lakh rupees mortgage of gold, the basis of we not get the 1 lakh rupees gold. There 30% of the is margin. Suppose that time the 70,000 loan is get to the customer and 30% is the margin. During the inflation period, the RBI used this margin 30 to 50%, so customer get only 50,000 rupees and they get less loan and less spending and cut down the purchasing power during the inflation. And on the other hand, during the period of deflation, recession, RBI reduced this percentage from 30 to 20% and increase the their loan amount. Increase loan is increase the expenses and increase the consumption. The central bank fixed the minimum margin as per their guidelines. They are the percentage of value of the security that cannot be borrowed or lent. In other words, it is the maximum value of loan which the borrower can have from the bank based on the security. So maximum amount of loan based on the mortgage fixed by the RBI. So increase the margin in the inflation and reduce into the deflation situation. Fixation of margin required. The second is the rationing of the credit. The rationing of credit means the RBI fixed to quota of every sector how much percentage loan given to agriculture, how much percentage is given to industry, how much given to the service sector, how much to small scale industry, how much given to the large scale industry. Suppose in this example, the 20% is given to service, 40% to agriculture, and 40% to given industry. So rationing of credit, another select method, the controlling and regulation purpose of the credit control. It is generally of the four types. The first, the variable profile ceiling. According to the method, the central bank fixes the ceiling on the aggregate portfolios on the commercial bank. They cannot advance loan beyond this ceiling. Those given the ceiling rate to the every sector, fix the every sector. The second method, known as the variable capital asset ratio. This ratio which the central bank fix about the capital of commercial bank its total assets, and keeping with the economic exigency, the central bank may raise the lower portfolio ceiling and also vary the capital asset ratio. So this is the method is the rationing of credit, given the fixed quota to every each sector and ceiling point. The next is control on consumer credit. Control on consumer credit means the commercial bank lend loans and advances to customer for durable and consumable items. So it's also facilitate installment to the customer when they give loan to the customer, and there is the supply and the easy loan. RBI impose the restrictions on the consumer or consumption loan to reduce the demand for their goods during the boom period. It also reduces the number of installment so that the loan demand is decreased by oversharing of loan amount, and the contrary, its relaxation given or restriction reduced on loan in recession situation. It boosts the demand for the loan and boosts the production of sales, and it boosts the economic growth. So control on consumer credit, it's use the quantitative tools by the RBI. So control on consumer credit, their loan amount, number of items, and it is the number of installment. EMI is also reduced or increased through all these tools. The next is a model session. So RBI use this model session to the given suggestion, advice to commercial bank adopt the central bank policy or follow their rules and regulations. So this method is highly effective as a selective method of credit control in India. The executive head of the central bank, the says a meeting of head of the commercial bank, wherein they explain then the need of the adoption of this policy, particular monetary policy, context of current economic situation, and then appeal to the follow it. So RBI given the moral appeal to the bank, follow their rules and adopt this policy during the particular situation, and what is their purpose of adoption of this monetary policy. But sometimes the bank not follow their rules and regulation, they use the another method. Model session is the just given suggestion and advice to the commercial bank. But bank if not follow their rules, that time another method is used. The publicity is another way. The qualitative credit control. The central bank also use the publicity instrument to credit control. They publish weekly, monthly, the statement of the asset and liabilities of commercial bank for information of the public. So public know the which bank is performed well, which bank is performed is the good, and which is the good for their deposits, and which is the not performing well. So RBI given the publicity to good performance banks, and they publish there the total deposits, money supply, NPA, and the audit report. It also publishes statistical data relating to money market and the various sectors data like export, import, agriculture, industry, and growth of the economy. This data is published by the RBI, and this data is published in RBI bulletin monthly, quarterly, half yearly, and also published annually into RBI bulletin. This is another way the exerting the moral pursue on the commercial bank. So it is the Also on the way to moral pursuit on the commercial bank adapting to the central bank's monetary policy. The aim of to make the public aware of the policy being adopted by commercial bank and vice versa. The central bank is in light on the prevailing the economic condition in the country. So aim of this tools is the aware to the public what method used by the RBI and the central bank and given awareness to the public and awareness of the public about the banking condition and publicity of the worst condition of banks and good condition of banks. The last option used by the RBI or every central bank when the commercial banks not follow the properly their monetary policy and the rules and regulation. So central bank in all countries frequently use these option, the direct action. Direct action in the form of directives issue from the time to time to commercial banks for the particular policy, but some banks is not follow this policy. The central bank refuse the discounting facility to these certain banks and stop their transaction particular period of time, merge one bank into the other bank, or the cancellation of license of the particular bank under this direct action. So direct action taken on to the management, direct action taken on to the banks. So it may be also charge a penal rate of interest from those banks which is the borrow from the beyond of their prescribed limit. If more loan are distributed behind their limit, that time the penal interest rate charged to the bank. The central bank may even threaten commercial banks to be taken over by in case of fail of its policy and instruction. So that action is the last option into these quantitative tools which is used by the central bank or the RBI. So summary of this lecture, what we learn from this lecture, we learn here the money supply, the total stock of money circulation among the public at the particular point of time and economy. And the most of important function of central bank is the control of credit control because of the control to inflation and the deflation pursue with this economy, create a stable situation in economy. Central bank adopt two methods, the quantitative and the qualitative methods to credit control. The quantitative methods aim is controlling cost and quantity of the money supply, increase the quantity of money supply, reduce the quantity of money supply. Therefore, they use the bank rate, repo rate, reverse repo rate, CRR, SLR, and the open market operation is selling security and repurchasing securities. On the other hand, the qualitative method used for the given direction to money supply, which purpose money should be used and which purpose should not use, which direction money supply is goes, it's given to the qualitative methods. So margin between the loan and mortgage, credit, rationing of the consumer loan, control of consumption, moral suasion, publicity and direct action used under these qualitative methods. So this involves safety credit control and the direct action. So this point you can refer the reference and textbook M.L. Jingle macroeconomic theory in interpretation Mumbai, or also you can R.J. Rasa, P.Adhav, Gotekar, Ghola, Business Economics, Sem-IV, Prashant Publication Book Jalga, which is available in market and library or online also. So here we end today's topic. Assignment question on this topic. Explain the credit control method of RBI, which is asked for the 15 marks. So there is two methods, quantitative and qualitative methods. So thank you for watching this video. Next time we will be looking next point in next video.